You're still watching a CNBC-TV18 Earnings special. We are here at the Infosys campus. Now, before the break, we told you about what Vishal Sikka had to say about the outlook going ahead. I also caught up with MD Ranganathan, also called Ranga, the CFO of the company, and Praveen Rao, the COO of Infosys, to get more details on the numbers. Take a look. Praveen, my first question to you. We already spoke about this, but let me ask you then. Retail, can I say that the fluctuation across the retail segment will continue for at least a year, or can you expect perhaps a pickup by the end of the year?
Our expectation is it will continue to be volatile. Difficult to put a timeline to that. This quarter we had a good performance in retail. But having said that, when you look at the environment, we have seen record number of store closings. We have seen a lot of layoffs and other things. And retailers are trying to compete aggressively with the big technology players who are also getting heavily into the retail space. So while on one hand there is a lot of pressure on them, and the strengthening of dollar is also not helping the global retailers and the CPG companies. So our expectation is while they will try to focus and invest on newer technologies, supply chain, analytics, omnichannel commerce and so on, but at the same time given the environment and the demand and the dollar and other things, difficult to predict, so we expect the volatility to continue.
So by when would you know what way retail is headed? By the second half of the year, will it be clearer?
Again, I mean, difficult to put a time frame because these are all macro conditions, so difficult to really pinpoint when things will be different.
Okay. BFSI, by the second half of the year, you are expecting more visibility?
Yes, mostly, I mean, when you look at BFSI, our performance is on expected lines. We believe we have a dominant position in that space. We have captured a lot of market share in the last few quarters. So we are fairly optimistic about that space. We are doing well in Europe and rest of the world. Americas is where we are hopeful that the spend will start. We'll see some pickup in the spend in the second half, but we have to wait and see.
Okay, what kind of a pickup would be? Would it be moderate or would it be higher than what you were?
I mean, as you said in the beginning of this year, there's an expectation that with higher interest rate and lower spend on the regulatory stuff, clients will start focusing on some of the newer areas like digital, cyber security and so on, those kind of things. But again, difficult to quantify it, but there's an expectation that there will be a pickup in spend.
Okay, fair enough. Ranga, I know you don't want to give a timeline on when the capital allocation will happen, but explain to me the process now. You already have gotten the necessary board approvals. What are the regulatory approvals that are needed? Is there an issue with respect to clarifications that have been sought? What's the reason for the lack of clarity on when and which quarter in FY18 you'll be able to?
Well, I think there is a lot of clarity on what is the capital allocation policy. We clearly said how much of the cash on the balance sheet as of today. We say up to 13,000 crores will be returned to shareholders. There is also clarity on how much of future cash flow will be returned to the shareholders. We have again said up to 70% of the cash flow. There has been a lot of clarity and predictability in that. I think, as I said earlier, as we are a globally listed company with large global shareholder base, we need approvals from multiple regulators, which to finalize a mechanism in which this would happen, and we are hopeful that we will close it in a timely manner.
Okay. Can I say the third quarter? That's what shareholders have been that's what analysts, have been trying to guess, given the kind of regulatory approvals that are required.
I don't think, as I said, we don't want to indicate, but one particular commitment we have is it is in fiscal 18, and we want to do it in a timely manner as quickly as possible. That commitment is there.
You're not going to give me a timeline.
We have to, as I said, we have to look for those approvals.
Okay, fair enough. Ranga, let me ask you about the margins then. As far as wage hike is concerned, that will have an impact in the next coming quarter. That is the quarter that we are in right now. What are the other levers? I believe that automation has impacted the margins in a positive way. Utilization has also benefited. What are the levers that will continue? Can you give me a quantum?
Well, I think if I step back and look at the last 2 years, right? Our operating margin has been resilient despite multiple headwinds of pricing or cross-currency movements and so on. Last year was 24.7. Year before that was also in the range of 25. So it has been resilient in the last 2 years. And last year, for example, we gave a guidance of 24 to 25. We ended up at 24.7. We exited the quarter at 24.7. However, we said, look, for this year, we gave 23 to 25. Keeping in view multiple factors. One, of course, is the rupee piece, which has already appreciated on average basis 3.5%.
Yeah.
So that was taken into account. Second factor, of course, the U.S. talent model ramp-up was taken into account, and the compensation increase. So when we gave that band of 23 to 25, we took into account all these factors, though we exited the last year at 24.7. Now, this quarter, we have been able to stabilize it at 24.1 operating margin, same as what it was last year, same quarter. And as I said, we have announced the comp increase, which is going to happen effective Q2. Likewise, our U.S. talent ramp up, and we have to watch the rupee. So keeping in view, though we have 24.1, we retain our guidance at 23 to 25.
There's been a 200 basis point positive impact because of utilization. Is there a scope to inch this further up in next quarter?
If you look at this quarter, the rupee impact was close to 80 basis points negative, which was to some extent offset by 20 basis points due to cross currency. So that is net negative of 60 basis. If you look at the positive things, the utilization itself gave us close to 90 basis points. Then we had price realizations improvement that gave about 50 basis points. Then it was offset by we want to pay our employees good variable pay. So that was offset by higher variable pay and some subcon costs and so on. So overall, I think the operation efficiencies did help us this quarter. At the same time, we have to work towards multiple. We can't really tag on to one operational efficiency lever. Like I said, on-site mix is something we need to focus on. And this quarter, for example, on-site employee cost as a percent revenue come down.
Exactly. So I'm actually coming to that. Is there a scope to inch that further, given the fact that pricing has increased this quarter? Is there a scope to inch that further, the on-site and off-site mix?
I think quarter to quarter it will be volatile. I think a better and more stable indicator for pricing is really year on year. For example, if you look at this quarter, year on year on a constant currency basis, is a decline by 20 basis points. Though it's not much, but it is declined by 20 basis points on constant currency. I think pricing we need to watch a more predictable indicator is a year on year rather than quarter to quarter.
Okay. Just taking from that, Praveen, in terms of the client outlook, aside from retail, are other clients also seeing cost takeouts? And if yes, are there areas where clients are asking for price cuts across the traditional services specifically?
No, there is no price cut per se. I think today the focus is more on trying to take cost out from the traditional areas and the side of the business, shifting into this one. So there is no price cut. Whenever any deal comes for rebid, there's an expectation. Budgets are stable.
Budgets are stable, okay.
Budgets are stable. And
this is across clients?
It's across across industries, there may be few client-specific things. Some clients may be spending more, some may be less, and so on. But across industries, we are not seeing any trend of any price pressure or anything of that kind. It is just the repurpose happening. The nature of demand is changing from a typically large deal, multi-year kind of thing. Its ticket sizes have become smaller. There are a lot more of deals. People try to develop in an iterative way and so on as they experiment and so on. So there's a shift in the nature of demand, shift in the kind of work we do kind of thing. But otherwise, pricing is stable.
We're not done with the big Infosys voices from the COO and CFO. We also spoke to 3 of the top presidents of the company. Listen in.
The good news is that the growth is actually very broad-based. The BFSI segment did really well. The telecom sector did really well. We grew in energy. We grew in our retail. So I think the fact that we are seeing multiple industries growing strongly in the European region, and this is again not just restricted to the UK alone, it is also in continental Europe. So I think some of the fears which we had is probably not really played out. It's probably still early to say whether there will still be some impact. We have seen some latency in the market because of the new election which happened in the UK and the fact that there wasn't a majority government. we saw the election in France. There was some trepidation around that, but I think the fact that there was a resounding selection of the new president, etc., has also given a little bit of a boost to the businesses there. So our hope is, and at least we're not projecting any major decline in the European business. We expect this to continue.
Okay. So what about deal pipeline? Is that expected to be better this year than FY17? Is there an incremental uptick that you're seeing in budgets?
I think the budgets are maybe marginally higher. It's not significantly higher. The large deal pipeline as it used to exist is actually shifting. We are seeing the spend gravitate towards much more shorter burst projects, much more agile projects, spending which is a lot more ROI focused, etc. So the way we used to look at the large deals, which is the reason why this year, from this quarter actually, we actually started reporting the growth on the new services which we launched 2 years ago, and new services and software which is now about 10%. We felt this is the time to now focus on that because that's how we are seeing the shift in spending happening, and that's the strategic priorities of the client.
Ravi, as far as the outlook is concerned, in the domestic side, in the India business, there seems to be a pickup. After GST has kicked in, now, are you expecting the base to change now?
So, we have a very controlled exposure to India. We're doing only projects which are very transformational. We've picked up a few important ones, and we have a very small base. We'll continue to remain that way. We'll continue to take good quality engagements. GST will continue to grow in terms of stature as a program. There is a future release which is coming up, which is about taxpayers and the invoices which are actually going digital with the taxpayers. But that's an ongoing journey, and then the GST will actually create an ecosystem where a lot of corporations across India will start looking at how to actually enable themselves with the new GST system. So that's a downstream opportunity for us with corporations in India who are going to get enabled and compliant on GST. So India is always going to be a controlled experiment for us. You
want to add to that, Mohit, in terms of the kind of scalability model that the domestic market will have now? Contracts are significantly lower compared to. Do you want to add to that?
I think, look, I think Ravi has covered. Let me hold that mic for you. It looks like a really large.
We are used to it. This is our
really large mic. I think, as Ravi mentioned, we have historically been, we don't have a very large footprint in working in India, and I feel that we are going to continue to be selective in the programs that we do, only the ones that are transformational. The one other place where we do have a very large footprint in India is because of Finacle, right? And that will continue to grow. The banking industry in India is, completely transforming itself with everything that is happening around the payment banks. I feel that will be a significant growth opportunity for us. Obviously, as you pointed out, the scale will still continue to be fairly small compared to our global businesses. That will not change.
So that was a comprehensive analysis of the first quarter earnings of Infosys, the FY18 outlook of what lies ahead for the company. All the top voices right here on CNBC-TV18. With that, it's a wrap on this special edition of CNBC-TV18 Earnings Central. From all of us here on CNBC-TV18, goodbye and thanks for watching.